let's get started on our last chapter. Well, you still have the chapter 7, but that's we're not going to lecture anymore on the chapter 7. That's just doing the payroll project. Okay, so in this chapter, we're going to take all the information that we have gathered from the previous chapters, all of that tax information, and we've got to learn how to make the correct journal entries to enter it into the financial accounting system. Now, this is one of those jobs that, normally it's the accounting department that would probably make those entries, but it would be with the help of reports that are generated by the payroll department. So the payroll department would do all of their stuff, put all their reports together and hand it off to the accounting department, who would then enter the proper journal entries into the financial accounting system. In order to do that, we have to use those that employee earnings record and the payroll register. If you remember using those, it's been a couple of chapters before we've looked at those, but those are the main pieces of, that's where we're going to get the data in order to make the journal entries. Okay. We're going to talk about certain types of deductions, voluntary and involuntary. We have to take those. That's part of the journal entry that is being made. Actually, there's a series of journal entries and they're done in a certain order. But those voluntary and involuntary deductions are part of that journal entry. We're going to look specifically at those journal entries. And then the next step after, and several of you are taking or have taken principles of accounting or intro to accounting. So you're already kind of familiar with the accounting cycle, that you make those journal entries and then those journal entries get posted to general ledger accounts. So each of our payroll entries have a general ledger account attached to them. So we'll go through what those general ledger accounts are and how we take the journal entry and then post it to the general ledger. Also, so we have there are kind of 3 main journal entries that are made. The first journal entry is made at the time that payroll occurs. So cash is going out. So that transaction, that's the trigger for making the journal entry. That cash is going out, we're paying employees, and so a journal entry has to be made. There are two different journal entries that happen during that time, but the trigger on both of those is that we are paying the employees, and so that those journal entries are going to be made. The next journal entry occurs when we pay those payroll taxes that are due, right? So we've withheld income from individuals' paychecks. Now we have to remit it again. So the trigger is that we have to pay some cash out for those tax deposits or other different types of amounts that have been deducted. So if health insurance has been deducted, we're going to have to make a payment to the health insurance company. If life insurance has been deducted, again, any type of deduction, but that's the trigger for that journal entry. So those happen at different times, but they're part of the same series of journal entries. And then the last type of journal entry, it's not actually a cash transaction that occurs that triggers the need for it. It's the end of an accounting period. That might be a monthly accounting period, quarterly, annual, might be all of the above, right? So we need to make some end of the period adjustments to properly account for those expense items that need to be recorded in the proper accounting period. So like at the end of the month, we're in the middle of a payroll. We haven't paid the employees yet, but we have accrued some payroll expense because we've got employees that are working and we're going to have to pay them. So the end of the month comes, we have to make a journal entry to record what it is that we owe those employees in the next pay period. So the trigger for that is something happens, the end of some time period. like I said, monthly, quarterly, annual, that sort of thing. So it's not like a cash transaction that occurs that triggers the need for that journal entry, but it's the end of a time period. So we're going to go through all of those journal entries in this chapter. So all of the payroll transactions we have to enter, and you already know these two items because we talked about them right back in the first and second chapters, that payroll register and the employee earnings record. So the information is gathered and entered into those reports, right? Then we use those reports to create the journal entries that we're going to make. We post everything in the general journal where we make those journal entries. Does everybody, when I say journal entry, does everybody know what I'm talking about? Yeah, debits and credits? Okay, good. So we create those journal entries for the payroll and the amounts that have been withheld from the paycheck. We make journal entries for payroll taxes that are the responsibility of the employer as well. So we've got two different entries that are happening. One that represents the amounts that are being paid to the employee as well as the amounts that were withheld from their paycheck. And then another set of journal entries that represent the amount that the employer owes for payroll taxes, so their portion of those payroll taxes, so their half of Social Security and Medicare taxes, FUTA, SUTA, all of those items, as well as any workers' compensation insurance expense may be included in that as well. Then, and these two happen at the same time. Next one, we make a journal entry to record the payment of payroll taxes when we actually make that deposit of the payroll taxes. And then again, we make the journal entry for the end of the period adjustments. And then once all that's done, it gets posted to the general ledger. Actually, it automatically gets posted, as you probably know, through the software. It goes through that whole system by itself. Back in the olden days, you had to do it all by hand. I'm not that old. I never knew of a time when I had to post these entries by hand. I've always used software for it. But that's the cycle for our payroll entries. So let's get a little reminder of what that payroll register looks like. So remember, at the payroll register, let me see if I can, I'm going to, hold on just a second. I'm going to pull up the book so that we can look here. Oh, come on. Sorry, I should have pulled this up before I started and think about it. Oh my God. All right, so what the heck is going on over here? Sorry. That sounds like a call coming in. Hopefully it's... I don't know what that is. Mute. So let's kind of recall what that payroll register looks like. I don't know if I can make this bigger. Yes, I can. All right, so remember our payroll register is going to have information about every employee who was paid during a particular pay period. So it's going to have all of our totals, which we're mainly going to be grabbing our information for our journal entries from the payroll register. Now, obviously, employee earnings records are important because that's the information for each individual employee, and it's cumulative over the course of the year. But for when we're talking about our journal entries, the information in journal entries is a conglomeration of information from all of the transactions, all of the paychecks that have been issued during a pay period. So that means we're really going to be mostly focused on extracting information from the payroll register. But just as a reminder, so we have a line for each of our employees. There's information here about filing status. Now they've got the old method here of number of withholding allowances. We really wouldn't have that anymore. But the amount of hours that were worked, how much they're paid per hour, what the total amount paid, plus overtime earnings. So here, this is just showing half of the sheet. This is only the income side of that payroll register. Do they have the other side? Yes. So it would continue onto this side. So the regular hours, regular earnings here, plus the overtime earnings would be added together and totaled for the total earnings. So here's our total income, total gross income for each employee. And then down here at the bottom, this is kind of weird how this is the total amount for all employees. So in this case, and they've got a kind of a band here to represent the fact that there are probably lots and lots of employees on this list. So it's not just these employees, which is why these numbers down here really don't match up. But what it is down at the bottom is a total of all of those amounts. So total earnings, and here it says it would be $24,762.70. That's the total gross amount of paychecks for this pay period. It looks, like I said, it looks a little funny because they got the 247 here in one column. But that would represent a sum of all of the amounts that were paid. So the amounts down here, the totals, this is actually where we would glean our information for the journal entries from those totals. And then we've got the amounts that have been withheld, both individual employees for each row, and then in the total column, we've got the total amount of taxes that were withheld. So for OASDI, for Medicare taxes, federal income taxes that were withheld. So you can see in this particular pay period, $3,714 was withheld in total from all employees for federal income taxes during this pay period here. State income taxes, and then all of our other types of deductions, which in this case, they only have group insurance listed as the only benefit, but that could be all sorts of different types of benefits that are withheld from employee paychecks. And then the net amount of the paycheck that is paid. So that would be, of course, the total earnings minus all of these withholdings. So in this case, in the first employee, $699.20 is the gross amount. After the withholdings, the net paid $606.93. And then over here to the right of that would be the amounts that the employer is responsible for paying. And you'll see that these are the same amounts. So you've got OASDI here and OASDI here. And I'm not sure what they've got. That's actually the total amount of, so these are the taxable earnings, sorry. So this would be the amount of earnings that are subject to those taxes here. So amount of earnings subject to Social Security, Medicare tax, amount of earnings subject to FUTA and SUTA tax as well. And then there should be, they're not showing it here, but the column would continue on, or the columns would continue on to indicate the actual amount of taxes that the employer owes as well. So you'd have all the information there for the journal entries that you're going to be making, okay? Gross earnings, individual withholdings, net amount of cash that's going out right now, being paid to employees, and then also there will be another section for the amount that the employer owes for those taxes. Okay. Oops. So, and this is just kind of showing the same thing here, what those telling what those columns are, and what all of the information that's on that payroll register. they mention here this term of footing or proving the payroll register. This is where you make sure that all of your columns running down and all of your rows going across total each other. Now, in this day and age, it's not as important. I mean, you still want to do that, but when you're using spreadsheets and software, it's not quite as, it's more of a cursory glance that you're doing that to make sure that everything totals properly. When we were doing it by hand, that would be critical. So we'd need to know that, you know, all of our total withholdings and subtracted from our gross pay also equals the total of all of our net paychecks. So that's what they're talking about here with these terms of footing or proving, ensuring that the columns and rows all total to the bottom right-hand number of the spreadsheet. Like I said, since we're using software and since we usually use spreadsheets, it's a lot easier to do that these days. They give you an example, I guess, of a manual proof on page 6-4. We can take a quick look at that. Where's 6-4? So this goes into a little bit more detail, proving the totals in the payroll register. Do they give us an example? Not really. I don't see it. So this would be an example as well of one way to do that. So you'd have all the information about the regular earnings, how much was paid in overtime, total earnings, all the amounts that were withheld from employee paychecks, so our total deductions here, so what our net pay should be, and then our total earnings. So you could do this in this type of format and then double check it over, make sure it matches the spreadsheet that is represented in the payroll register. So it's just a way of making sure that all of those numbers are correct. All right, so as a reminder as well, the employee earnings record, remember this is a record that is prepared for each employee and it's cumulative for the whole year. So from January to December, the employee, it would just keep getting added to every year. This employee earnings record is used to prepare the W-2s at the end of the year because it gives us the total amount of gross pay, amounts that have been withheld, and the net pay, all that information that's required for the W-2. The employee earnings record keeps track of that throughout the year. It's also used, we use it to prepare the payroll register as well. So all the information from the employee earnings record can be transferred over to each of the rows on the payroll register. Helps us to prepare reports for unemployment, state unemployment or disability laws. So it helps us that gives us information for those. Again, we talk about the accumulated wages. So without having it cumulative, we wouldn't know that an employee has reached the Social Security wage cap, or we wouldn't know that they had reached the FUTA or SUTA wage bases, right? That helps us to determine that when an employee has met those caps. Also helps with analysis for different governmental agencies and for internal management control. So a lot of accountants, internal accountants, will use this information for management purposes. So to help determine where expenses, like if one department is their cumulative salaries are running higher than usual, these reports can be used by internal managers to help make business decisions within the organization as well. So not just used for government or for external reporting agencies, but also internally within the company itself. I say here it helps to settle employee grievances. So if there's any question about, how much somebody was paid, it can be referenced to show an employee exactly how those calculations were done. And like I had mentioned, that report is used to issue the W-2s as well. All right, so let me see on my notes here if I want to use this. All right, so just kind of a little refresher. I know you guys you're all familiar with this, but just to kind of bring it all together. So we use accounting in order to create financial reports. Financial reports, financial statements are used by lots of different classifications of users. Like I said, it could be used internally, right, by managers to make management decisions. Also used by creditors. So if a company wants to borrow money, they will need to produce financial records in order to substantiate how creditworthy they are. Are they going to repay it or not? Helps to determine interest rates and that sort of thing. Investors, so if you've got individuals who are wanting to invest in the company, buy stock in the company, the financial statements are used by investors to assess whether or not it's a good use of their investing dollars. You know, it helps them to compare companies. Which company am I going to invest in? I'm going to use the financial statements to make that assessment. Governmental authorities as well will use financial statements, like the SEC, the Securities and Exchange Commission, which oversees publicly traded companies on stock exchanges. So they will use those. The financial statements have to be submitted to those governmental agencies. Unions will also receive copies of the financial statements and will be interested to see what the financial health is of the company through using those financial statements. You know, they can use it in bargaining and in their negotiations. So as a reminder, debits and credits mean something different than what they mean on your bank statement, right? If you look at your bank statement, if something is credited to your bank statement, it means you got money coming in. You got a credit into your account. You had a deposit or some sort of transfer in. On a bank statement, a debit means it's money coming out, right? You've used you can think of it as like your debit card. That's why they call it a debit card, because it's coming out of the account. That's for bank statements. Completely different meaning for financial statements, right? So for financial statements, debit just means left. Credit just means right. That's all it means, because with any journal entry, you got two sides you got two columns. You got your debit column, that doesn't look like a D, but there we go, and your credit column. I don't know why debit is abbreviated DR. There's no R in debit, but that's how it's abbreviated, DR. So with your journal entry, you've got a debit side and you've got a credit side. And then over here, you have an account, a general ledger account that's listed. With every journal entry, you have to have at least two accounts that are used in that journal entry. So, for example, let's say cash. Cash is a pretty popular account. And another, some sort of expense account. Well, let's just say payroll expense. Oops, that's it. That's not a P, that's an R. All right, so we have our two accounts for that journal entry. Now, in addition to needing at least two accounts listed here for each journal entry, we also have to have at least one debit and at least one credit. And those debits and the debit and the credit, the column has to equal each other. Okay? So you can't have a journal entry where you only have debits. You can't have a journal entry where you only have credits. And you can't have a journal entry where the debits and credits don't equal each other. Okay? So for example, and again, so this just means left, and this just means right, because debits are on the left and credits are on the right. So there are certain account types that have normal debit or credit balances. And those, I don't know if anybody has shared this with you, but the best way to remember is debits are going to either be assets, so debits, normal balance, which simply means that you are going to increase it, you're going to debit it. To decrease it, you're going to credit it. So normal balance, so increase to debit, are going to be assets. So asset account, cash is an asset. Expenses and dividends. AED. If you're from Iowa, you're familiar with Anderson Erickson Dairy, AE Dairy. They've got the best sour cream dips with all different flavors. AED, AE Dairy. Assets, expenses, and dividends. In order to increase amounts in these accounts, you debit them. So in our example here, in every other account, all others, you would credit, here, do this. You credit to increase. Okay, so all others have a normal credit balance. So let's just say, for example, let's use this very simplified journal entry up here. Cash and payroll expense. If I am making a payment for payroll, I'm paying my employees, what's happening with my cash? Is it going up or is it going down? It's going down. Exactly. Well, if my normal way to increase an asset account, cash, is to debit it, if it's going down, I'm going to do the opposite. I'm going to credit it. Credit means the cash is going out. So let's just say I'm paying somebody $1,000. It's very simple, simplified. That means my payroll is going up. I'm increasing it, right? The expense is going up. So again, I'm going to debit it here. It's one of those expense accounts. So I'm going to debit it. 1,000 there. So in this journal entry, I've done everything that I need to do. I have at least 2 accounts listed. I have at least 1 debit and at least 1 credit, and my balances match each other. I've got $1,000 here and I've got $1,000 here. Those are the requirements for the journal entries. Yeah. Well, so normally visually, normally the debits are going to come first, but I just happen to write cash. I don't think there's any hard and fast rule that says you have to do it that way, but yes, you are correct. Normally you're going to list your debit accounts first, but not always, right? There can be exceptions to that. You're still going to get the same result, right? But just know that those 3, I've got to have at least 2 accounts, at least 1 debit, at least 1 credit, and the debits and credits have to equal each other. So what types of accounts are we using for payroll? So I've got 2 of them listed here that are commonly used, cash and payroll expense, but we've got a lot of other types of accounts as well that we use in payroll. Expenses could also include, so we've got payroll expense. That would normally be, actually, it should be like wages or something.
So based on this context, the this journal entry would be that you're basically paying the expense but with the cash.
Yes, exactly. So you're using cash in order to pay that expense. Now, remember I said, so asset, expense, and dividend accounts. And we're not really talking about dividend accounts in this class. You talk about it in your financial accounting class, but not here. We're really mostly interested in asset accounts, expense accounts, and then also liability accounts. Amounts that we owe to other people. that would be, so payroll taxes, right? Federal income taxes. When we pay our employee, we're withholding payroll taxes. We're withholding federal income taxes, state income taxes, Social Security and Medicare taxes. We're not paying that money right now, though, right? We're just holding it. We're taking it out of their paycheck and we're setting it aside because we're going to have to pay it in the future. That would be a liability account, and that would be under one of these all other types of accounts. So equity would be another one. Those are the main ones. Those are kind of the broad categories of accounts. But anything with a liability, we would credit to increase it. Any asset or expense, we're going to debit to increase it. Okay? So different types of accounts that we would use. Let me see. I'm kind of running out of space here. Let me erase this right now. So wages or salaries expense. And again, so that's an expense account. So it would have a normal debit balance. Cash is a popular one. Let's see, federal income taxes. Well, how do they? I want to use the same terminology that your book uses. There are also no hard and fast rules about how you name these accounts, but I think it's important just to be clear with them. Let me see what they. What are they calling them? I thought they had a section that had the different account names. Oh, they kind of are. Here, let me see. Okay, so here they've got a couple of different names here. So federal employees, federal income taxes payable, or employees FIT payable, let's call it that. It's important though here to put the employees part in here to distinguish it from any amounts of income tax that the company may owe, their own personal taxes that they may owe. So employees FIT payable. Anytime you see the word payable, that is a liability account. That's something that's going to have to be paid in the future. That's a liability. You want to make sure these accounts do say like expense or payable, because sometimes the account names are very similar to each other. But in addition to that, we would have employees SIT, state income tax payable. Right? We would have, let's see some of these other ones that they've got. Federal income taxes, FICA taxes. So FICA taxes payable. And they have these separated. Who's spelling this? Payable. OASDI, FICA, erase this because I'm running out of room. Payable, HI, or that Medicare portion. So there's our wage or salaries expense, which is an expense account. Also, it's a good idea for companies to, especially larger companies, where they have different departments, to indicate what department is that salary expense coming from. The more detailed you can be about this information that you're providing in the financial statements, the more usable information you have. So, for example, wages expense, payroll department. Wages expense, purchasing department. Wages expense, sales department. Because then when you run a report, you know exactly in which department those expenses belong, right? So it gives more detailed, more granular information. Here they've got the example, so maintenance department, residential services, department A, department B, department C, whatever the company, however the company divvies up their organizational structure. So like DMAC knows, they would have salaries for faculty members, salaries for full-time faculty probably, salaries for adjunct faculty, salaries for administrative positions, salaries for secretarial positions. You know, they would have all of that separated out so they know exactly how much they're spending in each of those categories. Some of the other accounts here. So the state income taxes payable, which we listed there. SUTA taxes payable, FUTA taxes payable. Again, liabilities, because it says the word payable. Disability insurance payable is another option. Anything that's for those types of accounts. Other types of garnishments, or not garnishments, withholding. Well, garnishments would have their own category of accounts. So garnishments payable would be one. Insurance, health insurance payable. Let me see if this works better. So union dues payable. Any amounts that the employee has chosen to or is required to have withheld from their paycheck would be under these different types of payroll deductions, and they would have their own account in the general ledger. Now, when you're going through and you're doing your payroll project, remember, I kind of gave you a little sneak peek at the chart of accounts. The chart of accounts is just the listing of all of the account names for a company. And in your payroll project, the only accounts listed are payroll-related accounts. It's not going to have all those other types of accounts like rent expense and utilities expense and things of that nature. It's only going to be those accounts that are related to payroll. All of these accounts, again, would have some sort of general ledger account attached to them. These are the accounts that I'm talking about that are necessary for each of those journal entries. We've got to have at least 2 accounts. There is 2 sides to every journal entry. Let's see. So here's some other group insurance premiums collected or group insurance payments withheld. So amounts that have been withheld or collected that will then be paid to the insurance company. Again, this is a liability account, so health insurance. Now they have collected here. Sort of the same as it's really a payable. It's an amount that's being withheld and then is going to have to pay. Health insurance is kind of funny though. How it usually works is it's usually a prepaid expense. So the employer will pay the premium up front at the beginning of the month, and then the employee essentially pays their share of it throughout the rest of the month through payroll withholding. So the employee is paying the employer back during that month, but the employer has already fronted the money and paid it to the insurance company. So it's prepaid health insurance in the account. So government savings bonds, again, if the employee wants to have savings bonds, if they want to have some of their income diverted into savings bonds, they can do that. That would be withheld. There would be another account that would record that in a journal entry. Union dues, so like union dues payable. Again, that's going to be withheld from an employee account. Any other garnishment. So garnishments in general payable. So if an employee has a garnishment for child support, say, that amount is withheld from their paycheck, and then there's some deadline probably early in the following month that the employer then has to make that payment for child support, but it's been withheld ahead of time from the employee's paycheck. We'll go through some of this stuff. There's an ordering to garnishments that we'll go through in this chapter as well. Let's see. Oh, you got it? So this is not an exclusive list. These are just some examples of different types of accounts that are used in payroll. So you can see here. So here's an example of an employee that's earned $1,290 is their gross pay per week, but they have all of these amounts that are withheld from that paycheck. So they've got their federal income taxes, FICA, OASDI, Medicare, state income tax, and then they have to pay something towards state disability insurance, credit union deduction. So I guess they've got an amount that gets diverted to a credit union account, probably a savings account, that sort of thing. Health insurance premium, charitable contribution. There are employees that will withhold, have money withheld from their paycheck to donate to charity. That's a common way. United Way does that a lot, where they will, so employees can make a contribution to United Way and it's automatically deducted from their employee paycheck. That is not a pre-tax deduction. It is a post-tax deduction, so you do not get a benefit for that, a tax benefit for that, at least at the time of your paycheck. So the calculation here that they've done for the net paycheck, they've just taken the $1,290 and subtracted all of these withholdings to get a net paycheck of $1,041. Let's see, I think those are pretty much all of the account names. That we would have. Okay, these are important because these are, once we once we make the journal entries, and then the second step is to post to the general ledger, or the general journal, all of these accounts are listed in the general journal. So we would need to know which accounts so that when we transfer it over, and the general journal is like those, well, actually I think it's more like the general ledger. The general ledger is like the T accounts. You probably talked about the T accounts in your classes. So it gets transferred from the journal entries onto those T accounts. So let's go back. All right. So this is the order in which everything gets entered. First thing we're going to do, and it may get posted, may get entered to the employee earnings record before the payroll register or vice versa. That would just kind of be a matter of preference, but those are first in line. Then all the journal entries that have been made are recorded in date order in the general journal. These are the 4 major journal entries, which we've already kind of reviewed. And remember, I said we've got 2 that happen at the time that an employee gets paid. Then we have 1 that happens at the time the taxes get paid. And then we have our end of period adjustments that happen at the end of a period. Nobody's been paid at that point, but we have to make these journal entries at the end in order to properly reflect all of the expenses and liabilities and assets at the end within a proper accounting period. All right, so let's take a look at these journal entries. On here, I want to make sure I'm at the right place here. Went through that, group insurance. I talked about that. I talked about all of these withholdings very briefly, but went through them. let's look at the entries. I'm going to scooch forward here to do this. All right. So the entries that we have to make in order to record the wages that are paid, so the salaries and wages that are paid, and the amount of payroll tax expense, those liabilities, the amounts that have been withheld from an employee paycheck. So the first journal entry is to record the wage expense and the liabilities for FICA taxes and federal income taxes withheld. You can think of the first journal entry as it concerns everything from the employee's side. Nothing that the employer owes. What has the employee been paid? What's their gross paycheck? What has been withheld from the employee's paycheck? What was their net paycheck? So it all centers around, this first journal entry centers around everything that happens on the paycheck. Okay, for each, well, not for each employee, it's all combined together for all employees. That's what the journal entry would represent. But that is the first journal entry. The second journal entry is the amount that the employer owes. So the first one's for employee, what the employee is being paid and what is being withheld from their paycheck. Second journal entry is what does the employer owe now as a result of paying those employees. Remember, the employer has Social Security and Medicare tax requirements, right? They've got FUTA tax requirements, they've got SUTA tax requirements. That second journal entry is going to record how much they owe as a result of this paycheck that has occurred. These two entries are always the same in format. Both of these journal entries have to be entered at the same time, and they happen when an employee is paid, when at least one employee is paid. Okay, so maybe it's a regular pay period. That's fine. It's recorded. It's gonna include everybody's salaries and the amount that everybody has been paid. But it has to, both of those have to happen at the same time. Okay. So let's take a look at doing that. All right. So let me erase this. Hopefully I can get this off. Oh, this whiteboard is so bad. All right. So for our first journal entry, here's our payroll register. Very simplified. We only have two employees, employee A, employee B. We've got their gross amount of pay, Social Security withheld. There's no information on this. Very simplified. There's no information about hours worked or anything like this on this particular payroll register. Social Security that was withheld from their paycheck, Medicare withheld, federal income taxes withheld, state income taxes withheld, and then insurance that was withheld. So for each employee, we have here the gross amount of pay, and then subtract all of the amounts withheld to get the net. So for both of these employees, and then we've added the two together for our totals. This total amount here is what we're going to use for our journal entry. Everything is there to create our journal entry. Now we do have to know, what are these accounts? So this net amount, what does this represent? The net amount. That's the total. It's the amount that the employee is actually going to get paid, right? That's the amount of cash that's going out right now. That's the amount of cash. These are liabilities. This is the total expense. So for our journal entry, we have an expense, which is going to be probably, I guess they've got wage expense. Remember, we've got our debits and our credits. We will start this time with the debits first. So we've got our wages expense. This is our gross payroll. Okay, I'm just putting this down here. This is not like a notation that would be put in the journal entry, but just so you know, this is always going to be our gross payroll. How much was our gross payroll? Our total. Yeah, $18.45. So our debit to wages expense is $18.45. All right, so we've got one entry now. This is an expense. We are increasing our expense, so therefore it's a debit. Okay, it's one of those AED accounts. So we're going to debit it. Now, we also have some liabilities. These are going to be listed next. So we have what? Employee, what are they going to call this? I don't know what they call it. Employee, OASDI, I'll just call it that. Employee, HI, these are separate accounts. Employee, FIT, these are all payables, by the way. Payable, payable, payable. What type of account are payables? Liabilities, exactly. So what's their normal balance? Are they a debit or a credit? With the normal? They're a credit, exactly. So we're going to enter those over here. And then we've got employee SIT payable, and we've got insurance. Oh, we'll call it collected. But it's also a payable here. So these are going to be credits. Our total amounts there. So $114.39, HI $26.75, FIT is $170, SIT is $50, insurance is $191. Notice these are the totals for all employees. All right, so at this point, again, these are all liabilities. Here, if we were to add all of those up, remember both sides have to total. So let's get a total line down here. Right now, $18.45. And how much do we have on the left side here? 114.39. Whoops. Plus 46.75 plus 27 plus 50. Shh. Trying to take too fast. Sorry. Now we got 552.14. So obviously we are not done yet because these two don't balance. They have to balance, right? So we need to enter our net paychecks. That account is cash because that's the amount of cash that's going out right now. That's what we're actually paying them. So $1292.86. Now if we add that all up, plus $18.45. We balance. You got it? Okay. Our journal entry is complete. The first journal entry that we have to make another journal entry as well. To represent, remember, this is only one, these taxes that are being withheld are only half of the story. Because the employer also has Social Security taxes and Medicare taxes, and they're also going to have FUTA taxes and SUTA taxes that are related to this paycheck. So there's the journal entry, just like what we have here. They don't put the total at the bottom, but it's always a good idea to total them to make sure that it works. If you're doing it in software, guess what? They will plug that final number with some uncategorized account, and then you'll spend hours trying to figure out why you don't balance and what that uncategorized account where that's supposed to go. So there's the first journal entry. Now let's look at the second journal entry. Remember, so what we need is the information from the other side of the payroll register, the employer's information. So same employees, here's our same gross amount. We've got FUTA wages and the amount of tax that is associated with those wages. SUTA wages and the amount of tax that is associated with those wages. Now you'll notice here, we've got employee, if you look, so employee A, none of their wages is subject to FUTA tax. That means, what does that mean if none of their wages are subject to FUTA tax? What would that mean? What's that? There's nothing to, right, but why? Say that one more time. I guess I didn't understand your first word. I'm sorry. I don't understand the first word that you're saying. So, okay. Yeah, we're basing it, but we have nothing here. Like this, they had $1,000 of wages, but none of them were subject to FUTA. Why? Exactly. Yep. They're over the 7,000. They've already earned over the 7,000 for the year, right? We can assume that. We can surmise that by the fact that they have no FUTA wages here, right? And then employee number 2, only 615 of that 845 is subject to FUTA taxes. So that means during this pay period, they reached that 7,000 for the year. So that's why you see that this is a good representation of what happens in a pay period where you've reached it. Not all of those wages are going to be subject to that tax. Same thing with SUTA wages. So what can we say about the SUTA wages here? So 800 of their $1,000 are subject to SUTA wages. What's happening? What's happening there? None of their FUTA wages were subject to tax, but 800 of their SUTA wages are subject to tax. Why isn't this 0? Not unlimited, but exactly. There's not the same limit. They're in a state where the state SUTA threshold is different from the federal threshold because 800 of their wages are still subject to SUTA taxes here. Now, we don't know what the limit is, based on this information.
So because there's not SUTA, but there's like the
No, there is a limit because look, in fact, they reached that limit this month or this pay period because not all of their wages are subject to it, but only 800 of their wages are subject to it. So that $7,000 limit is only for FUTA wages. We don't know what the SUTA limit is, but it's something different from 7,000. Otherwise, this would be the same, right? And then we can see for employee B, all of their wages here were subject to SUTA. So they haven't reached the SUTA limit yet for their state, whatever that limit is. We don't know what that limit is, right? We could figure out what the tax rate is because we've got the amount of tax here that's been calculated. So we could figure out the tax rate, but we don't know what that wage limit is for the state that they're in. But the calculation has been done here. So this would be 0.6% of the 615, and then this would be whatever the percentage is of the total 1,645 wages that are subject to SUTA taxes. And then we've got our OASDI wages. Now, we can see all of those wages are subject to OASDI, Social Security, so neither one of those employees has reached the Social Security wage base. right? They're not near the 160,800. I think that's what it is. All right, and so there is the employer's portion of Social Security and the employer's portion of Medicare tax. Well, look, lo and behold, it's the same as the employees, right? It's exactly the same, but this is everything that the employer owes. So this was our journal entry number 1 with the employee on the employee side. Journal entry number 2, still going to do our debits and credits. We've got these amounts that we have to record. So payroll tax expense is what we're going to debit. So it's all going to be in one lump sum. So we've got our payroll tax up here. This is going to represent our total. And then we're going to have amounts for each of these. So we've got FUTA tax payable, SUTA, OASDI payable, HI payable. All right. Easiest way to do this is to first do the credits, because what we're going to have to do is just add up the credits, and the difference is going to be our debit. All right, so we've got 369 here, 4606, OSJ 114.39, and 2675. All right, let's total this up. Right now we don't have a debit, but we're going to figure out what the debit should be. $190.89 is what our debit is going to be. That's called a plug. You don't know exactly what the amount is, but you know that it's the total of all these other amounts, right? So this, we balance. Cool. We balance. We have at least 2 accounts here, and we've got something in the debit column and something in the credit column. And there it is. So if we go back, wow, that, oh, shoot, I don't know. I was going to look at that, the payroll register that we had in the, well, maybe not. It was too hard to see it all. Scratch that. Okay, we'll continue on here. Okay, so this was journal entry number 2. The other one was journal entry number 1. And then I said we've got 2 more journal entries that we have to do. Both of these journal entries are done at the time that the employee is paid, right? We've just got the employee side, and then we've got the employer's side of all of those expenses and liabilities. Now, we've got all these liabilities sitting out here. We have to pay them, right? So when we pay those, let's take a look at what happens then. Where am I? Sorry. We'll talk about that a little bit later. Well, I guess actually what we'll do. Okay, so what I want to do, we make our journal entries and then we post to the general ledger. So for the general ledger, I'm just going to use, I may have to go back and use these. I'll use the slides as for the source. All right. Anybody know what this is? T account. Exactly. Each account in our chart of accounts has a T account. This is the general ledger. So every time we post one of those journal entries, what happens is we then move, let's go back to journal entry number 1. We then move each of these entries into their own general ledger account. So we have a bunch of T accounts. Here's our wages expense account. FICA taxes payable. FICA payable, HI payable, employee FIT payable, employee SIT payable. My handwriting gets worse every single one I do. Group insurance. Withholding, I guess, that's what we'll call it. That's another kind of payable account, but it's not really a payable in the traditional sense because it's being paid back to the company. So the company is collecting it. They don't have to then pay it out because they've already paid it out. They prepaid it. We've got cash. Let's look at our. And then we've got this journal entry that happened as well. Payroll tax expense. Has a T account. FUTA payable. SUTA. And FICA taxes payable, which we already have up there, and OASDI and HI payable. Okay, cool. So with each journal entry, what happens is we transfer each of these entries over into its proper T account. So we've got wages expense. And again, debits on the left, credits on the right. Wages expense is a debit. So we're going to put it right there. 114.39, it's a credit. So we're going to put it on the credit side. 26.75. All right. FIT payable is 170. SIT payable is 50. Group insurance, 191. Go to the next one. Payroll tax expense, 190. Oh, I forgot the cash. Sorry. Whoops. 1292.86. So this is a credit on the cash. That means that the cash that went out, hopefully we had a debit balance in there before. Otherwise, we're overdrawn, right? We didn't have any money to begin with. FUTA 369. Oh, 190.89. That's our debit. You notice both of our expense accounts have debit balances there because we increased those expenses. SUTA taxes payable, 4606. And let's see, FICA taxes payable, another 114.39. So here's the employee portion, here's the employer portion of those taxes. Medicare taxes payable, 26.75. Again, employer portion of those two. Here's our current balances in these accounts. The third journal entry that occurs is when we actually have to pay those liabilities. We've got several liability accounts up here. We've got, this is a liability, this is a liability, this is a liability, 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 liability. Not really a liability. I mean, it is a liability, but we've already paid it back because the employer made the payment up front. So now the employees are just paying it back. So all of these liabilities are due. We're going to have to make the payment for those amounts. So the next journal entry that occurs, let's see if I can get to it here, is for payment of these liabilities. Now we've got to make that, this is the third in our series of 4 journal entries. Okay, are we on time? We can go through this third one. All right, so remember, when we are paying, what is this? Increase in operating expenses. Yeah, this isn't the one that I want, though. This is a different entry, sorry. They used a different example here. Okay, so the deposit of the payroll taxes. So if we total these two up, right now we have a balance of $228.78 here. Here we have a balance of $53.50. We have a balance of $170 there. We've got a balance of $50. $46.06. And remember, only one payroll has occurred. Chances are, before we make these payments, there are probably going to be multiple payrolls that occur, right? Maybe we have another payroll. Maybe we pay twice a month and then we make the payment for the taxes in the middle of the following month. If that were the case, then we would have more entries here and we would have additional amounts that are due to be paid. Right now, though, just to keep it simple, these are the balances that we have in our liability account. So now we've got to make the payment. That's the third entry. So when we make that payment, remember, we're going to pay these at the same time. This is the Social Security tax, Medicare tax, and federal income taxes. Those are all going to the IRS. FUTA tax, we don't have to pay that yet because we haven't reached $500. We only owe $3.69. We'll assume we haven't reached the $500 for the year. So that's just going to sit out there until January, probably, that liability. The SUTA tax, we don't have to pay that until the end of the quarter. So maybe it's not the end of the quarter yet. That also is just going to sit out there until we make the payment. Right now, what we're going to do is make the payment for Social Security, Medicare, and federal income taxes that have been withheld, and these amounts that are owed by the company. So this is what happens. Here's the journal entry. I'm going to make this a little bit smaller here and have some space. So we're going to debit, and we know we're going to debit because we're going to eliminate this. We've got a credit balance. That means we're going to have to debit it to bring it to zero so that we don't owe it anymore. So we've got our FICA OASDI debit credit of $228.78. We've got our FICA HI of $53.50. We've got our federal income tax payable of $170. We're going to pay all of these. What's the account that we're going to pay it from? Cash. Exactly. We got cash going out. Well, I guess it's right up there. You could just look at the journal entry. All of these totaled up $452.28. Then what happens is this again gets posted. We made a journal entry, so that means we need to post that journal entry to the general journal. So now we're going to have $228.78, which brings our balance to zero in this account. We don't owe anything. We paid what we owed. 53.50. So again, we're debiting these, so we're going to put it on the debit side over here. Just moving that to there. 53.50, so again, 0. Federal income tax payable, 170. So now we owe 0. And then we've got cash, got to fit it in here, 452.28. That's going again on the credit side. So we got more cash coming out. Again, hopefully we had a balance of cash in there to start with, because otherwise we're in trouble, right? So 3 journal entries that we've gone over. First one records, what's it record? First one. Right, and it's the amount that that it represents the paychecks, right? The employee paychecks, the gross amount of pay, all the amounts withheld, and the net paychecks, all totaled up. Second journal entry. Yes, the employer's responsibility. Very good. The employer's responsibility for the taxes on their side for that same paycheck. When do we make those 2 journal entries? At what point in time do we make those journal entries? Yeah, when we pay the employees. Right. At the time that we write those paychecks, we make those first 2 entries. Third entry, what does that represent? What are we doing there? Right. Yeah. So we're making the payments for the liabilities that we incurred. Now, there are going to be other payments that we have to make too. I think there's another one here for the state. Yeah, so there's one. Oh, well, there's for the FUTA. So state income taxes and SUTA taxes. Now, these are going to be made at the time that we actually make the payment. We may make this payment and this payment at different times. But whenever we make that payment, that's when we make these entries. Once we make the entries, we post it to the general journal, right? General ledger. I get those 2 confused. I'm sorry. I should figure this out. Which one comes first? General ledger? General ledger. Sorry. General ledger. J comes before L. Okay. So we post it to the general ledger. Every time we make a journal entry, then it gets posted to the general ledger. And then this gives us a snapshot at any point in time, how much we spent, what our expenses are, how much cash we have, what our liabilities are. This is our income statement and balance sheet, right? All of these accounts together are income statement and balance sheet. All right, so we will, and then this is at whatever point they owed the $369. Again, if they didn't reach the $500, they don't have to pay this until January 31st when they finish up the 940 form. Let's see. Okay, so there's a 4th category. I'm not going to go through these today. I just want to give you a little preview. There's a 4th category of journal entries that have to be made, which are not triggered by a payment. These other 3 were triggered by some payment that we made, some cash going out. This is not triggered by a payment. It's triggered by the end of the period. It's January 31st. We have to make these. It's February 28th. We have to make these. Or it's December 31st. We have to make these. It's a period in time that triggers these, not a transaction itself, but a period in time. And these are the adjustments that have to be done at the end of the period so that we accurately reflect what our expenses and our liabilities are at that moment in time. Okay? And that's where we'll pick up on Wednesday. We're probably gonna be finished with the lecture part of this chapter on Wednesday, to be honest, which gives us next week to catch up on stuff, to do work. If you want to do work in class on homework, we can go through problems. I can put together worksheets so we can do more of these exercises if you want to do that. To work on the final payroll project, and I'm here to answer questions. So it'll be kind of a little bit more free time for that kind of stuff next week. Okay, but we'll finish up this chapter on Wednesday. Okay, it's a pretty quick chapter, really, especially since you've all have some experience with debits and credits and journal entries and stuff like that. All right, any questions? Right on. Okay, I will see you on Wednesday.